Welcome to this strategy on trading supply and demand and power zones. As per normal, we'll go through the selection, timing, management of the strategy, followed by a practical, so that you can really see how we can apply this strategy to the markets before your very eyes. Now, there are numerous advantages or pros to this strategy over and above just trading price action on its own. And the key benefit, of course, is that these our entries essentially rely on levels of support and resistance, the very levels which the banks and institutions have their orders set up on. So this means that we can get into the big moves at the very beginning. We could benefit from a free trade earlier and essentially move our stop loss to break even quicker than if we were relying on a price action based entry. We can, as I mentioned, benefit from the key levels which the big dogs or the big players in the markets have their orders, like the banks, institutions, funds, hedge funds, and there are a few rules to entry like there are of price action. As some of you who've traded price action before, certainly with lazy trader strategies, you'll find that there's a much more comprehensive filtration process to getting into a trade and managing a trade to this one. So the setups might be fewer, but you'll be easier to have access to getting into the trade by following the rules. Furthermore, the reward potential is far greater, and as you'll discover, the management style of this really does epitomize set and forget. Even when you place your orders, you can simply walk away for weeks, if not months, and just wait for your order to fill automatically if the market gets to it. You'll have your stop loss already in place, and of course your limit order if you're that way inclined. And it goes without saying really that just like with every other strategy we have, we can apply this same logic to any other asset class, whether it's currencies, stocks, commodities, indices, you name it, it can be applied to everything. And there's minimal subjectivity in it as well. So it's very much rule-based, and for any strategy to be mechanical and be a successful strategy on its own merits, then it has to be rule-based. And it's a very simple set of rules which we'll give to you in just a second. As for the pros, there are also cons, and of course this strategy won't suit everyone, but we thought it would be fair to give you the balanced scorecard so that you can really make an informed decision as to whether it really does resonate with your personality or not. So the first drawback with this strategy is that there are far fewer opportunities to trade. We'll be trading on the daily and the weekly time frames, off levels which haven't broken in over a year, and in quite a few markets, depending on the cycle it's in, might not have this opportunity for quite some time. So a big part of this strategy is actually sitting on your hands and being patient. The old chestnut, being patient and disciplined, will save you and ultimately make you money in the long run. Okay, so again, the fewer rules to entry which are required to enter a trade as and when we do get our setup could of course perpetuate a fear-based emotion for people who do like to have a number of boxes ticked before entering the markets. And of course, with that in mind, what's related to that is the fact that we don't rely on price action indicator-based confirmations like RSI or stochastic. Of course they're a bonus, but they're not essential in this strategy, which once again could inhibit you if you do like a confluence of reasons to get into a trade. So this might not be for everyone. However, you'll get a closer look as to whether it really is for you or not in the forthcoming presentation. But first, what is exactly supply and demand? This is a term which is abounded about a lot by technicians and traders, both amateurs and professionals alike. But what is it? There are many definitions out there, but I can make the definition very simple, and I'm going to do this by simply saying that a level of supply is essentially a level of resistance, a sell level, where we can reasonably expect a ceiling at this level of resistance where people who are long into this level will think about unwinding their positions and will see the sellers coming back into the market. So this will be at a point where there'll be more people wanting to sell than buy, and of course a level of supply can also be termed as, in the interest of simplicity, just simply a level of resistance, a ceiling or a horizontal level. So to really kind of like make it simple for you, you could just simply say to yourself, a level of supply is exactly the same as a level of resistance. And by the same token, a level of demand is a level of support, the opposite of a level of supply. A level of demand is a buy level, and typically at a point where we've had people who are short into a level, a horizontal level, looking to unwind their positions, and where we're anticipating buyers to come back into the market or come into the market. Essentially, where there's a perception of value for the buyers to buy, then we can typically expect there to be a level of demand. And these tend to occur around key levels of support, i.e. a horizontal level with a minimum of 2 touches. We can also call, in the interest of simplicity, a level of demand a support level, a floor, or just merely a horizontal level. So in order for this strategy to work effectively, we want price action to be approaching a hard level of horizontal resistance or support on the daily or the weekly chart for the best potential outcome and for the highest probability of it working out. Okay, so let's recap. What is a hard level? Okay, well, a hard level of supply, also known as resistance or simply a sell level, is one which is held for at least 10 months. And it's one which is tested twice at the very least within that 10 months. Okay, so on the flip side, a level of demand is a horizontal level of support, also known as a buy level, which once again has held for 10 months and has been tested at least twice within that time frame. You might be asking, why the hard time frames though? Why do we care about the hard time frames? Well, theoretically, you could actually apply this strategy to any time frame, by the way. You could apply the same logic to the hourly, the 4 hourly, the 5 minutes if you really have that level of testicular fortitude. However, given the many benefits of the daily and the weekly, it means that we have a solid market perspective and structure. It's better established and the levels are far stronger for that reason. Okay, it means that we can essentially enter into the bigger picture moves with minimal effort in setting up and managing our trades. We can quite literally set the orders up and walk away. Whereas if we did trade the hourly or the 4 hourly or even the 15-minute for that matter, it will mean that we have to do or be tied to a physical location in order to manage the trade. And that certainly for a lot of people who are working in the daytime, I've got other commitments, it's a bit of a bind, and you'd far rather use trading as a vehicle in order to have money working for you, rather it being the other way around, rather than you really having to work for your trade and manually keep altering it and managing it. And so that's why we use the daily and the weekly. Obviously, the harder time frame, the stronger the structure, and the less work in terms of management is going to be involved. So let's take a look at this hypothetical example here. Do we have price approaching a valid level? We've got price trapped in a range here. We've got certainly the first test here on this level of supply, also known as a level of resistance. We've got the second test, which makes it a valid level of supply. So this is our opportunity to sell on the third test. On the flip side, we've got the first test on the level of demand, the second test, and now we've got the third, we've got the opportunity to buy as well. And then again, before price actually comes to this horizontal level. Remember what I said, a minimum of 2 tests on a horizontal level. We could essentially trade it on the 4th or the 5th test. It doesn't have to be the 3rd only, or confined to the 3rd test. So as you can see here, the level of supply, i.e. this level of resistance, has had 2 tests, so it is valid to sell on the 3rd bounce, like so, off this horizontal level, and vice versa on this demand level. There's 2 tests, the very minimum required, so we can legitimately buy on the 3rd and the 4th bounce. Okay, and we can see that this has occurred over a 10-month period, or in excess of a 10-month period. So as you can see for yourself, it's relatively straightforward. And just to recap, in what technical aspects we need for both a buy and a sell setup, well, as you probably guessed, for a buy trade setup, we need a level of demand or support which is held for at least 10 months and has had at least 2 previous tests or points of rejection. But crucially, when I say it's held for 10 months, we do not want a close below the horizontal level, because when that happens, when we get a close of price action below the horizontal level, it means the level is invalid. And so the structure is invalid, so that means the trade is not going to be very high probability in comparison to if the level has held. On the flip side, we've got the sell trade setup, as I'm sure you're probably thinking already, based on what you've learnt so far, 10 minutes into this presentation. A level of supply or resistance will be a cornerstone for a sell trade setup. And when I say a level of resistance, I mean one that's held for at least 10 months. It's had at least 2 previous tests or points of rejection, and crucially no close above the horizontal level, because just like with the previous buy trade setup description, if we get a close above the horizontal level, i.e. above the level of supply, that means that the level is now invalid, and of course we want the level to be a watertight ceiling in the way of price, and we're not going to get that if we've got the close above the level if we're looking to go short, or the close below the level if we're looking to go long. So let's have a brief exercise just to really test your understanding in hard levels. This is important in the selection of the trade. So let's take a look here. Can you see with the naked eye the hard levels of supply and demand? Let's take a few seconds. This is pound CAD, the currency cross pair. It could be anything. This is just an arbitrary chart, by the way. It could be gold, a stock, an index, a bond. It could be anything, but we just happen to have chosen pound CAD. So this is our level of supply, the ceiling or level of resistance, and this is our level of demand, where we can expect buyers to come into the market on the next test down. We've got 2 tests, we're just waiting for the third. But for now, let's talk about the level of a resistance. We've got the first test here, second, so after 2 tests the level is valid to sell on the third bounce of this level. So this is our sell opportunity here on the third test, and lo and behold we've got a 4th test, like so, another opportunity to sell, and lo and behold a 5th test to sell as well. And on the bottom side we've got the level of demand. We've got our first test, second test. So now this level of support or demand, whatever you like to call it, it's exactly the same thing, is now valid for a potential buy setup for the next time price comes down to intersect and react to it. We've seen it, price react to this horizontal level twice already, so it's likely that it's going to do it again. And this is what we're doing here with the charts. We're just looking at probabilities where price has been before, it's likely to go again based on its interaction with horizontal levels. And these horizontal levels are generally formed around big numbers, where banks and institutions, the bigger players in the market, essentially have their orders. Okay, so let's take a look at Aussie versus the Swiss franc. Again, where do you think this level or major level of supply is? Well, got it right here. We've got the first test, the second test, and we've got the level of demand on the bottom side. First test, second test. Now it's valid for a potential sell. On the third test, there we've got it. And now on the bottom side we've got 2 tests here, like so. And theoretically it's going to be on the third test on this level of demand. We're just waiting for price to come down before we can reasonably expect it to ricochet off this horizontal level for a third time, and this is where we'll be looking to buy this currency pair in that event. So as you've seen, hard levels are pretty straightforward to detect on the chart, and you can quite likely find yourself being able to find them in a very short space of time. If they're not obvious to the naked eye, then they probably don't exist. So don't find yourself looking at the chart and not finding anything and trying to force the levels, because when you're trying to do that, then the level, quite frankly, it's unlikely it's there. It's like a mirage in a desert. So just a tip for you, hard levels typically occur and instances of round numbers, multi-year highs or lows. This could be a 5, 10, 15, 20 or even a 25-year high or low, and or levels defended by central banks. For example, the European Central Bank, the Bank of England, the Federal Reserve, you name it. They do defend levels, key levels, and they've got a lot of money to defend these levels, the most out of any of the players in the markets. So certainly if a central bank says that it's defending a level, then they've got oodles and oodles of cash to throw at defending that level. So they're pretty reliable levels. Okay, so let's have a look at cherry picking, selecting the best and leaving the rest. And the best levels of supply and demand to trade off are essentially the ones which have had whiplash, isolated reactions off over a prolonged period of time. Like for example, we've got this level of supply here and demand, like here, representing the level of support. We can see that price has immediately tested this level and gone straight down again, just like it has this level of support. It's come down, immediately reacted upwards, like it has here. We've got a double bottom formation right here before it shot upwards. So this is exactly what we're looking for these higher probability levels to take advantage of. I mean, the tests might be far and few between, but if the market has demonstrated that the movement after intersecting these levels have been quite dramatic, and prices previously rejected these levels sharply and decisively, then it's very likely it's going to happen again. Okay, so this is how prices corresponded with these hard levels of supply and demand in a minimum of a 10-month period, 10 months to 2 years typically. It could be longer. So the hard levels which have had isolated whiplash rejections off over a prolonged period of time, a minimum of 10 months, are generally the best ones to trade off. Like for example, as we can see here, the FTSE 100, which is right before your very eyes. We've got this horizontal level of resistance, aka a supply, which corresponds with the penultimate all-time high, for your information. And we can see that price has come up, tested off it, very decisively fallen after testing it on its first instance. Second instance, we've got the same again. It's come up very decisively, tested the level before falling quite dramatically, and the third instance, it's happened right here. So this is the kind of profile of what we're looking for in terms of horizontal levels which have been tested and prices immediately reacted to it. So these might be few and far between, but they're very high probability in terms of the direction or the movement that occurs thereafter. Let's take a look at a buy setup here. This is the US dollar versus the Polish zloty, and we've got a key level of demand here, supply also. Essentially it's exactly the same thing. So we've got the first test on this level. The first test doesn't mean anything on its own, and now we've got the second test. So this means that on the third test, as when price comes down to this level, this is our opportunity to buy. So we place an order on the level to buy, our stop loss below the level, and we'll talk to you a little bit about stop losses in just a second. So this is our buy opportunity after 2 tests, a minimum of 2 tests. So first test just sets the scene, the second test is a mere coincidence, and the third test is our opportunity to enter for long, in this instance here with the US dollar versus the Polish zloty. On the flip side here, we've got, well, the FTSE once again making a second appearance. Just goes to show that this kind of works with any asset class. We've got the first test here and the penultimate all-time high. The second test, merely a coincidence, but the third test is actually our opportunity to go short in this instance, given that we've got a level of supply here corresponding with this level of resistance, which is exactly the same thing. So I just want to re-emphasize, we trade the higher time frames purely because they're much better and more reliable than trading the smaller time frames like the 15-minute, the half hour, or indeed the hourly. For a number of reasons, they give us a far clearer market perspective and vision of the market. The structure is far better established, and most banks and institutions out there do trade the daily and the weekly time frames. Contrary to popular misconception, a lot of people seem to think that Goldman Sachs and JP Morgan are there scalping the 5-minute chart, when that's simply not the case. They look to the higher time frames as far as my belief goes, and what I've been told as well from key people within the industry. And also means, most importantly, trading these higher time frames, we can take advantage of these enormous moves with minimal efforts and not having to really be in front of the chart very often to manage and maintain our trades. That for me is a real cornerstone and what lazy trading should all be about. So in keeping with lazy trading, what we want to do is simply place our orders with our broker, walk away, and, well, almost forget about them. Don't completely forget about your trade, but simply walk away and not mollycoddle your trade or managing it every 5 minutes like a lot of intraders do and burn themselves out. So simply we leave our orders with the broker. This removes emotion and second guessing in the heat of the moment. It means that if price is coming to fill our order, we don't get afraid and remove the order only to find that the trade goes our way, like a lot of people tend to do when they're watching price and getting triggered into a trade. So what we want to do is simply place our entry, buy and stop sell, depending on whether you're going long or short, our stop loss, which is absolutely mandatory, and a target or limit order, which is optional depending on whether you want to trail it or simply wait for price to hit your target. I recommend doing both, managing your trade as well as putting a limit order in. So let's take a look at this in context in placing orders for a long move or a buy off a level of support or demand, as you might know it as. Essentially the same thing. So we've got our 2 tests, we've got our buy opportunity here. So what we do is we simply place our order on or above the level with our stop loss below the level. It's as easy as that. And of course the distance between your entry and your stop loss will depend on how aggressive you want to be. I'd always recommend having 2 targets, the aggressive target and the conservative target. The conservative target being the one which is closer to your entry for a high probability, low reward potential outcome, where your target 2 is the more aggressive target, which could fulfill the completion of the range, or indeed the final part of it, the final leg of the completion of the range, as and when price action, or if price action triggers you in and moves up the full way. Okay, so typically when price triggers you in and you hit target 1, what people tend to do is scale out of the position, and if they're long, they sell half of the position so that they've taken half the profits off the table, remaining or leaving half the position to remain and potentially hit target 2. It might not, but that's what they'll do in order to take both sides of the coin, banking profit as well as keeping in the opportunity which is still valid. So let's take a look at placing orders for a short setup. We should have our entry just on the level or in advance of the level, just to ensure that we're triggered into the trade in case the market whiplashes and comes straight back down again. This is what tends to happen when we've got price coming towards a key level of supply or demand. So we have our stop loss above the level at a distance depending on how risk averse you are. It could be anything between 50 and 100 pips if you want to be relatively conservative. And we have our target 1 and target 2. Target 1 could typically be for a high probability low reward halfway down the bottom of the range, because it's quite likely or more likely that price is going to get there, and then it would be just to go to the bottom. So what you can simply do is when price gets to target 1, buy back half the position, so that means taking half your profits off the table and scale out in that fashion, leaving half the position to run to target 2. So setting up your stop loss is really the only discretionary element to this strategy, and you should really deal with this or play it according to your trading style or personality. But I just want to make you aware of the pros and cons to both approaches, both the aggressive and the more conservative approach, because different people have different trading personalities. So just to reiterate, a tight or a small stop, i.e. a smaller number of pips or points between your entry and your stop loss, will certainly be a more aggressive option. It will give you higher reward potential, but of course it will give you a far greater risk of being stopped out and sustaining a full hit in the event of a breakout, in this instance here. And certainly if you want to look at this empirically, then an aggressive entry will be anything between 30 and 80 pips difference between your entry and your stop loss. A bigger or more conservative or wider stop will reduce the risk of being spiked or stopped out in the event of a false breakout, but it will limit reward potential. As you can see, the bigger the distance between your entry and your stop loss will mean that it will inhibit reward, and typically a bigger stop will be anything upwards of 80 pips difference between your entry and your stop loss. But false breakouts do happen a lot within the market, and of course they're there to stop people out of trades, but there are ways that we can deal with this in a very logical way in order to eliminate the risk of being stopped out of a trade prematurely. Because there's nothing more frustrating than being triggered into a trade, stopped out, and for it only to go our way ultimately. And this does happen if you don't know about how to deal with false breakouts, or fake outs as we call them. Okay, so in order to factor in false breakouts, it means that we should have an appreciation as to where false breakouts have happened before, when it comes to the level we are looking at trading price action responding or rejecting against. So what we need to do is, if we're looking to go long, put our stop loss behind or below instances where price might have broken out or false broken out before. And if we're looking to go short, then we need to put our stop loss above the point where we've had previous false breakouts before. Let's take a closer look. So in this buy setup here, we've got hawking back to the dollar versus the Polish zloty. We've got this level of support here, a level of demand. So where would you put our stop loss? Certainly we put our entry just on or above this horizontal level here, but our stop loss should be at a point where the breakout or false breakout has occurred before. As you can see here in this instance, this bullish pin bar reversal, it didn't close below the level, so the level is still valid. So but price actually had the audacity to get there, so what if it happens again? It almost happened here on the last time it tested this level. So what we'll do, just to make sure that we don't get triggered into the trade, stopped out only for price to demonstrate a false breakout again before going long, is we simply put our stop loss below this level, or this point where it's had the false breakout. Okay, so our stop loss will be neatly tucked against that, just in case it happens again, because as technical traders, what's happened in the market before is likely to happen again. Here we've got the US dollar versus the Norwegian krona. We've got a hard level of resistance, or indeed supply here. You can see that we've had a few false breakouts where the level is still held, but we've had this price has had the audacity or the strength even to actually rise above this level before closing below it. So what we would want to do is simply, and this has happened on 2 occasions, we simply want to put our stop loss above the false breakout, or the point of the false breakout, like so, before having our order just below the level of resistance. So as a financial markets trader, we've got 2 key objectives for when the trade is in progress. Our first objective, or our first priority, is to preserve capital and bring the trade to break even as soon as we are able to, or indeed close the trade early in the event where the trade becomes invalid. This is important. This is all in the name of the preservation of capital. And of course our second and ultimate objective is to make money And we do this by locking in profit strategically and objectively if the trade goes in our favor. And we can do this by trading our stop loss incrementally in the direction of where the trade is going. So let's have a look first to see when or in what instances the trade actually does become invalid. Okay, for this buy setup here. We've got our entry on the level, just in advance of the level, and our stop loss below, but price has come down, and it's not only has it closed below the level, thus invalidating it, it's also taken us out for a full hit. And this is very unfortunate. It's the worst possible case scenario we can get from trading this strategy, but it does happen. You've got to sometimes lose the battle in order to win the war. That's so important. So this is an invalid setup purely because we've been taken out for a full hit and we've got to close below the level. On the flip side here, in this sell setup, we've been triggered into the trade. Our stop loss is above the level of resistance, and we've been taken out for a full hit. We've had a full, whatever we've risked on the trade, we've lost all of it, and we've had to close above this level, which means the level is invalid as well as the trade setup. So that's the worst possible scenario we can get. Invalid setup, invalid structural level, and a full hit. However, there are ways in order to get out of the trade if it's not going in our favor without taking a full hit. And this is important. This gives us an opportunity to preserve our capital without taking a full loss, and nobody likes to take a full loss. Okay, so remember, our first objective is to preserve capital as best we can, certainly when the trade doesn't go our way, but our second objective is to make money. But in this instance here, we've got a buy setup on this horizontal level. Price has closed below the level, which is a warning sign, but crucially the next bar has taken out the low of the bar which has closed below the level, which renders this invalid. And what we can do then is exit early at the point where the low of the bar which closes below the level is breached. So we can exit early without taking a full hit, and this is very powerful in preserving capital long term. It gives us a very accurate, well tried and tested warning mechanism to get us out of what is essentially a dud setup. On the flip side, we've got a sell setup here in advance of the third test on this level of resistance. We've got our entry on or in advance of the level. We've got our stop loss above it, true to strategy rules or true to form. But we've got the bar closes above the level. This has invalidated the level, an early warning sign, but it could be a false breakout. It could immediately go down and validate our trade again, but we'll have to see. So this setup is only invalid if the next bar after the bar which has closed above this level takes out the high of this bar which closed above it. So when it does, like so, we know to exit the trade prematurely without taking a full hit. And once again, this is so important in order to preserve our capital. Making money is one thing when the trade goes our way, but it's important to obviously know what to do and to minimize the downside when things don't go to plan. And of course, nothing is ever guaranteed in trading the markets, no matter how good the setup looks. So just to recap, the worst case scenario with this strategy is taking a full hit when price simply just goes and closes. We're looking to go long below the level and takes us out for a full loss. On the flip side, we're looking to go short, but price just keeps going up and up above our level of resistance and just hits our stop loss for a full hit again. That's when we have to endure a full hit, and this does happen. Vice versa, we can get out of a trade which doesn't look like it's likely to go our way by observing the following information. If we're looking to go long and price does close below the level of support, and the next bar crucially takes out the low of the bar which closes below this level, then we can exit this trade early and not endure a full loss. That's important, like I said before, and I'll shout it from the rooftops. If we're looking to sell, then once again, if we get a close above this level of resistance, which we're trying to sell off, and the next bar, crucially, takes out the high of the bar which closes above, then what we can do is simply exit early at the point where it takes out the high, so that we don't have to endure a full loss. We can have a small loss or a partial loss rather than taking a full hit. So we've talked about what to do in the worst case scenario when the trade goes against us, but what about when the trade goes in our favour? What do we do then, apart from just watching the money in our brokerage account getting greater and greater? Well, we need to manage this. Our first objective is to obtain a free trade and move our stop loss to break even for a no loss trade as soon as possible. And of course our second objective is to lock in profit incrementally and routinely so that we can steadily make money in the course of the trade going in our direction. But how do we know when to move our stop loss? That is the burning question. Well, as a rule of thumb, you should always trail your stop loss every time the market moves in your favor, the number of pips between your entry and your stop loss. So if you have a difference of 100 pips, say, difference between your entry and your stop loss, then you should trail every 100 pips the market moves in your favor. If, say for example, you have 50 pips difference between your entry and your stop loss, you should trail your stop loss 50 pips the market goes in your favor, and so forth. So every 100 pips the market moves in your favor, you should always trail 100 pips behind. If you don't want to do this, if you want to give the market even more room to breathe, then you can always be discretionary and trail behind key levels of support and resistance, or swing lows if you're going long, or swing highs if you're going short. It's up to you, but this way of trailing and locking in profit according to how many pips difference between your entry and your stop loss, or points for that matter, is very scientific. So let me explain in this animated example. Say for example we've got 100 pips here between our entry and our stop loss. We've got a good amount of breathing space, the market goes in our favor, 100 pips, then we can trail our stop loss. Now the market moves an extra 100 pips in our favor, so we can essentially lock in 1 or 2% depending on how much you've risked on this trade, and now it's just close to hitting target, and it does, and then we can either take our profit at this level of resistance, or we can trail our stop loss in anticipation of a breakout. So it's up to you, but this is just an example of how we can essentially trail methodically and mechanically. In order to determine how much we should trail our stop loss, this will always depend on the difference you've given yourself between your entry and your stop loss. So let's have a look at this short example. We've got 75 pips between our entry and our stop here, and the market moves in our favor. 75 pips, move our stop loss to break even, moves another 75 pips, then we can trail our stop loss again, so we've locked in some profit now, and now we can either hit target or take the profits off the table completely, or we can simply trail in advance of a breakout. So we've trailed for a third time, and that's how we do it. Trail incrementally. So let's have a look at the euro versus the Norwegian krona here. So you can see, first of all, we've got our two tests here on this horizontal level, our stop loss above the level, and we're anticipating price to come up and test this level before going down again. And we're entered into the trade, like so, and we've had that whiplash rejection off it, which is fantastic. So thanks to having our orders already there, we'll be triggered into the trade whilst we'll be doing other things. But let's take a closer look here. We've had our original stop loss above the level, and what we do is for every equivalent distance the market moves between our entry and our stop loss, we trail along the way. So in this instance, looking at Euro NOK, not only were we able to achieve a free trade and lock in a good number of percentage points, 4% within the same day or trading period, and we did this before we were stopped out, before price came up and retraced, stopped us out. But we'd already banked 8% with this one because we were risking 2% on this trade. So essentially it was a 4-to-1. Let's take a look at the US dollar versus the Polish zloty and how we manage this one, this recurring theme. Well, we had our entry above the level, stop loss below the point where it previously broken out, like we discussed before. So we anticipated price coming down to this horizontal level. We got filled in the trade. So as you can see, we're able to move our stop loss to break even after day 2, and then lock in profit strategically along the way. For every equivalent number of pips difference between our entry and our stop loss, the trade moved in our favour. We were able to trail that distance behind in these phases. So in this instance, we're able to trail our stop loss 3 times until we were stopped out by retracing price action, and it made a 6% gain, risking 2%. So all in all, this strategy is highly versatile and can work on any asset class and on any time frame. Of course, we always recommend the daily and the weekly for the aforementioned benefits. It has great profit potential and requires minimal time in the selection and management, as and when we get legitimate setups. However, the flip side is that opportunities can be few and far between. It's not suited for everyone, and certainly if you're risk adverse and you don't like essentially getting in the way of an oncoming train, or feeling like you're getting in the way of an oncoming train, then certainly you might want to stick to a price action based strategy when you've got more confirmations in your favor.